All right, Bulls and Bears, how's everybody doing? I hope you're doing well. How's everybody handling this cost of living? Well, I'm going to talk about my experience at Subway. Yeah, Subway, the sandwich shop here. I'm going to talk about that here in just a minute. But before we get started, I just wanted to put something out there, and that's kind of piggybacking on what we talked about in the last couple of videos. Is be very cautious right now. Here's just a quick headline, and then we'll move on to some of my local economic experiences here in a minute. I shouldn't be laughing about this here. Look at this headline here. This is how the Telegraph is putting it. The world stands on the brink of all-out war. We see what's happening over between Israel and Iran now. We know what's already been happening globally, and maybe this headline is too extreme. The world on the brink of all-out war. Some people say it's all nothing, doom and gloom. I've been called doom and gloom just for talking about it. But we've got publications out there like the Telegraph and others now saying, these things are very, very serious. What's going on here, right? So if you're not paying attention, there's a lot of tensions happening globally right now. A lot of people are saying it's the BRICS nations versus the non-BRICS nations or the dollar backed nations, so to speak. So there's a financial component to it. But the bigger financial component is if there's a big enough scare situation that comes up, World War III, of course, that could bring the markets down. That's going to rattle even the big investors, the ones holding most of the stocks, and cause a huge sell-off, right? So I'm just saying be cautious right now. I'm not saying run for the hills. Don't go hide in the corner under your bed and all that stuff. But be aware of what's going on, and watch what you do with your investment cash, right? Because you don't want to have everything invested at a time when there's a lot of serious risks out there, folks. All right, so let's get into my experience here. Subway, let me Subway sandwiches here. I know it's weird to go from global talk of World War III, global geopolitical stuff to a Subway sandwich, but gotta laugh at this. I shouldn't laugh either at this. So a Subway sandwich now, folks. Here's the one I used to buy, and let me see if I can get a full screenshot here. Sorry. Folks, here's my foot-long sandwich that I usually buy when I have to buy. Now, quick note, I'm not a big fan of Subway. I think it's mostly bread, but my kids like it, so I'll still go there every once in a while. Can you see this? $13.89, basically $14 now for a foot-long sub. I remember when footlongs were, I think, $7.99 if I remember correctly. So anyone telling you that there's 3% something inflation, you might want to second guess that. And I think most of you, of course, are well aware that the official numbers that are put out are completely underestimating the true picture of what's happening. Of course, they don't want to alarm people. They don't want to admit the real numbers. If they admitted the real numbers, I think society as a whole would be really pulling back on their spending. But when people see these little 3% inflation numbers, they don't think it's a big deal. And to some, it's not. But to most people are having a hard time. If you look at the surveys that are put out there, the 60 to 70, now over 70% people that admit that they're living paycheck to paycheck, they're getting in deeper debt here, right? And that's what we want to talk about next. We're going to talk about the economy. The economy in general, in the U.S. especially, is propped up by spending. And what's most of what people are spending right now? Is it saved money? No, no. If you look at the savings rate is near an all-time low, closest to the lowest it's been in 40 years. And no, it's borrowed money. Most of the money being spent right now is borrowed money. And here's a recent article that kind of highlights this here. Consumer credit signals outright weakness. Spending may drop. So it's not just me saying this, folks. This is known. They don't really talk about it that much, but the quote unquote experts out there, they know that this economy is driven by consumer spending that's derived from borrowed money, people taking on credit card debt, going further and further into debt. The question has been, how much more debt will banks allow people to get into? Remember, debt was way lower than what it was today back in 2008 when banks constricted the lending, they pulled back on the credit limits, and therefore the economy took an even bigger drop, right? So far, this I wouldn't want to say soft landing because we're yet to see any landing, right? There's talks of a soft landing, no landing, hard landing. The reason we haven't seen a soft or hard landing right now is because banks are still keeping the credit limits available so people can continue to go further into debt. When that stops, if and when that stops, I think it's a matter of when, not if, but when that stops, then you're going to see the huge economic downturn that so many people have been talking about for a long time. There's been a lot of people out there putting certain dates on it here. Unless you know the date when the banks are going to stop allowing this spending to happen, then you don't know the exact date. But then again, it could happen suddenly. Go back to the beginning of this video here today. If we have a world war situation, if we have the U.S. getting involved, not just overseas, but here on U.S. shores. Of course, something big could bring this down, so be aware of that. But this article points it out here: consumer credit signals outright weakness. Are banks starting to pull back on lending? All right, or are just people getting so close to their credit ceiling or their credit limits that they have to stop spending, or do they see how much they're paying in interest each month? I just watched a video yesterday talking about how a 7% mortgage rate is not really 7%. When you look at all the interest that's paid over the life of the loan, 30 years, for those that keep their home for that long, um, during the first few months, you're paying almost all interest. I think maybe $50 on the median home price mortgages going towards the principal at the beginning, right? So when it's said and done, you're paying 2, 3 times what the home is actually worth. So when you don't look at the APR, which is 7%, the mortgage rate 7%, when you don't look at it on an annualized basis, when you look at it just as a total that you pay, you're paying 200% interest a lot of times. You're basically tripling what the home costs in the total amount that you pay when you add up all the payments over 30 years, right? So a lot of the numbers you have to really look at and think about more deeply to really realize, how much we're actually giving to the banks. And again, these are banks that are loaning out money that they don't have. Right? I don't want to get into that because I've talked about that, a lot. Let's talk about this here out of the American what's it called? Prospect. How the Fed keeps getting inflation wrong. All right, but read what it says below here. More than 400 economists work for the central bank, for the Fed, and yet they still can't get it right. How much, if you add up the salaries of these 400 economists, how many millions and millions of dollars are we paying these quote unquote economists that can't even tell you what's going to happen with inflation? But yet, someone like me, and there's lots of others out there, telling you years ago, telling you inflation was going to continue to get worse, that it's not going to get better because nothing that's caused the inflation is being changed or fixed or addressed. But yet we've got a 400 economist strong entity out there getting it wrong on inflation. And again, for those of you that don't know what I'm talking about, just go back a couple years. Oh, it's transitory. Prices are going to go back down. Then it was sticky inflation. It was going to go back down. Now it's just going to be inflation is going to keep getting worse. It's just going to be going up at a slower pace. Except for last month. Last month was a shock there with 3.5% inflation number. And again, that's just the tip of the iceberg. If you look at the real numbers, for the Subway sandwich over the past few years, what it looked like, my favorite sandwich went from like just under $9 to $14, right? So that's a pretty big number. That's 50% almost, right? Just looking at a Subway sandwich. There's lots of examples. Look at your utility bill. Look at your insurance bill. Look at the cost of gas. Look at the price at the pump, right? Everywhere you look, it's outrageous, folks. And so we've got to be real careful with our money here at this time. A couple more tidbits that I wanted to get into here. U.S. Post Office raising prices again, the sixth increase in postage and stamps since 2020. Just something else to add on top of the pile of rising costs and debt that so many people have already buried under. Energy prices are up almost 30% faster than the 7 years prior. And this is just since 2020, right? So since 2020, energy prices up 30%. That's 13 times faster than the previous 7 years, right? So the amount of price increases, the amount of cost of living It's not just increasing; it's the increases are accelerating. Okay, so it's going to get a lot worse, folks, before it gets better. How much longer can the stock market and the markets in general, the housing market, how much longer can these markets remain detached? How much longer can they remain detached from money that people actually have to spend, especially when you look at inflation getting worse and worse and worse and savings dropping and dropping and dropping, right? There's got to be a detachment moment, in my opinion. Some people are out there saying it doesn't matter because the banks are going to continually be um, liquefied with newly printed money. So, therefore, the spending can keep on going even as people are broke, even as bankruptcies start surging, even as delinquencies for loans start rising. People say that the banks are just going to be uh, more heavily funded in order to keep the money flowing, in order to keep people borrowing and keep people spending. To me, that's a nightmare, folks. I'm hoping there's something that's going to drop this thing and send a wicked market correction into this U.S. economy. To me, that's the better of the scenarios. It's scarier because it happens more suddenly, but in the end, it's better when you get a price correction. The cost of living comes down. Pick up the pieces and start somewhere else. Start fresh or start rebuilding. Hopefully, in a more solid foundation. Right? Not money and credit, aka debt driven. Quote fake economic growth. Right? So we all want to be aware of what's going on here. Keep an eye on this channel. We're going to help you navigate through this and give you all the analysis, all the news, the headlines, and behind the headlines, behind the numbers, giving you the reason behind actually what's happening, not just reading off the headlines, but telling you the cause. And that's going to help us prepare even better, right? So please make sure you're still subscribed. Come back to this channel. We'll see you on the next video. Big love. Peace.